Apply for a digital loan in India today, and the capital often hits your account in fractions of a second. It feels instantaneous. This velocity is visible at every merchant counter and on every street corner. Repayments flow in through digital QR codes, but also through field agents who collect physical cash and deposit it manually at local bank branches. But that speed is a front-end illusion. Behind the scenes, the money is moving across a highly fragmented infrastructure: UPI, NACH mandates, and RTGS wires, each operating on its own conflicting clearing schedule. FinTechs frequently spend millions optimizing the instant front-end loop, but prioritizing customer acquisition without fixing the fragmented backend creates a business that eventually collapses under its own weight. Financial institutions operate under a strict mandate. You must be able to mathematically trace every single rupee's origin, current ownership, and associated fee deductions. This is the process of reconciliation. When a loan repayment is deducted on a Monday, the digital ledger records it immediately. However, the actual cash may get held in clearinghouses, not reaching the lender's bank account until Wednesday or Thursday. This timing gap creates a severe operational bottleneck. If you cannot prove that the cash in the bank matches the digital receipts in your software, you cannot legally deploy more capital. Take a single EMI repayment. A borrower pays exactly 5,000 rupees, but that payment arrives at the bank as 4,891 rupees. The difference is consumed by the infrastructure. Before the payment aggregator settles the cash, they take their processing fee. Then they deduct statutory taxes, including an 18% GST and a 1% TDS. There is a timing discrepancy as well. The borrower initiates the gross payment on day 0, but the net settlement clears into the bank on day 1. Legacy accounting software cannot bridge this gap. The system expects a 5,000 rupee credit on Monday, sees a 4,891 rupee credit on Tuesday, and concludes the borrower underpaid, automatically flagging their account for collections. This problem becomes unmanageable at scale. Payment aggregators don't settle single transactions. They bundle all of the day's collections into one massive, lumped-together midnight settlement file. Proving who paid what requires an N-to-1 explode transformation. The software must take that single bulk bank credit, the unique transaction reference, and mathematically map it back to thousands of individual borrower receipts. Different interest conventions across banks often generate micro-discrepancies of a few cents. If the software doesn't isolate and write off these rounding errors, the entire multi-million rupee batch stays unreconciled. Linear customer growth creates an exponential data crisis. 10,000 new loans result in 50,000 accounting fragments requiring verification every single day. This isn't just an internal efficiency issue. The Reserve Bank of India enforces strict guidelines on how these exploded funds must be handled. In co-lending models, every collected EMI must be split, often in an 80-20 ratio, and routed to a partner bank. These funds must move directly between accounts, without ever resting in an unauthorized third-party pool account. When a platform cannot instantly prove zero pooling compliance, statutory auditors have the authority to halt all lending operations. When transaction volume exceeds a team's ability to manually match them, the failures accumulate in financial suspense accounts. A growing suspense ledger hides a multitude of failures. Co-lending payouts to partner banks stop because the exact splits are unknown. Simultaneously, the lack of transparency creates room for field agent embezzlement. Missing cash deposits simply blend into the broader data chaos. This leads to a total freeze. With millions of rupees sitting unallocated and an audit deadline looming, the chief financial officer is forced to stop all new loan origination just to locate the capital already in motion. Hiring more operations analysts doesn't solve the problem. Throwing manual labor at a high-volume data crisis only increases the rate of human error. Survival requires a multi-pass matching engine. The first pass clears exact numeric matches, while subsequent passes deploy windowed and fuzzy logic to catch timing delays and rounding errors. The architecture must also include native data parsers. Banks rarely provide clean spreadsheets. They deliver cryptic text feeds like MT940 or CAMT.053 formats that must be ingested and normalized instantly. Finally, the system needs a cryptographic period lock. Once the month's reconciliation is signed off, the data is frozen, ensuring that no manual edit can alter the historical accounting record. Digital lending is an exercise in high-velocity accounting. The business can only scale as fast as its architectural capacity to prove the origin and ownership of every returning rupee.